Welcome back to the Deep Dive. Today, we are looking at a financial paradox that, quite frankly, kept me up last night.
Oh, yeah.
It's one of those situations where the headline numbers and, the underlying logic seem to be speaking two completely different languages.
It certainly goes against the grain of what you typically see or what we teach in, Business 101. It's a strategy that looks almost reckless on the surface.
Right.
But it might be the only way to survive and even thrive in the current economy.
Exactly. So let me set the scene for you. We are looking at the Q4 2025 earnings report for a company that just dropped yesterday, January 28th, 2026. And here's the paradox.
Okay.
You have a company that intentionally took a hatchet to its own profit margins. I mean, they slashed them. They're handing out incentives to customers that are so large, they practically look like typos on a spreadsheet.
It sounds like a going out of business sale, doesn't it?
It totally does. You'd expect the earnings call to be this somber, apologetic affair. You'd expect the stock to be in a free fall, but then the report comes out. And somehow, they beat Wall Street earnings estimates by 20 cents per share. They beat revenue expectations by a staggering $150 million. And instead of panicking, the analysts are nodding along.
That is the pace over price paradox. In a nutshell.
Yeah.
It's a high-wire act, and it's fascinating to watch.
Today, we are dismantling the latest report from Century Communities, ticker symbol CCS. And before anyone even thinks about reaching for the skip button, thinking, ugh, a home builder, how boring, just hold on.
Right.
Because this isn't really about architecture. This isn't about granite countertops or curb appeal. This is about the Amazonification of the American home. This is about how you turn a house into a standardized, high-velocity commodity.
That is the perfect framing for it. Century Communities isn't trying to be an artisan builder. They're not trying to win design awards.
Yeah.
They are a manufacturing machine. They're currently the 9th largest builder in the U.S., but it's their specific focus that makes this deep dive so critical right now. They live and die in the affordable and entry-level sector.
Which, let's be honest, in 2026 is the only sector that really matters. Affordability is the crisis of the decade.
It is.
If you can't build a house a normal person can actually buy, you don't really have a business model for the future.
Precisely. And so our mission today is to investigate this strategy they explicitly call pace over price. We're going to take apart their Q4 2025 report to understand how they're pivoting to growth in what is still a very volatile interest rate environment.
And we need to figure out if their whole land light model makes them a deep value buy because the stock is trading incredibly cheap right now, or if it's a classic value trap waiting to snag unwary investors.
Big question.
We have a massive stack of sources today. We've got the Q4 2025 investor presentation, the full earnings call transcript from yesterday, their 10K filings, and also some independent market analysis reports looking at the housing sector, particularly in the Southeast.
And we should probably say to you, the listener, right up front, whether you're an investor looking for undervalued stocks, or you're just someone trying to figure out how on earth affordable housing actually gets built in 2026.
Yeah.
This deep dive is going to connect the dots. It's all about the interplay between construction speed, interest rates, and of course, corporate strategy.
So let's get into it. Before we get to the financial wizardry, and there is some serious wizardry here, we have to understand what this company actually does. Because I think people hear home builder and they imagine a guy with a pickup truck and a roll of blueprints,
Yeah, meeting a couple on a muddy lot to decide where the kitchen island goes.
Exactly. And that's just not what this is.
That is the romanticized version of home building. For Century Communities, that image is almost entirely wrong. It's antiquated.
So let's define the niche. As you said, they are not building custom dream mansions.
Absolutely not. If you look at the data from 2025, 94% of their deliveries were priced below FHA loan limits. And that's a critical statistic.
Okay, let's pause right there because that's a huge number. Why does the FHA loan limit matter so much? What does that tell us?
Because it defines the customer. The FHA loan is the government-backed mortgage used primarily by first-time buyers or people who might have lower credit scores or smaller down payments.
The people who need the most help getting into a home.
Precisely. So if 94% of your homes fit under that cap, your customer isn't the cash-heavy luxury buyer moving from California. Your customer is the teacher, the firefighter, the young couple trying to buy their very first home.
It's the mass market.
It's the mass market. The average price of a Century Communities home in 2025 was $378,000.
Which, just for context, sounds like a lot of money until you hold it up against the national average for a new build.
Right. The national average for a new home is sitting around $506,000.
Wow.
So CCS is coming in well over $100,000 cheaper than the market average. That price gap, that is their moat. That's why they have demand when other builders might be stalling out.
But how? I mean, how do you build a house for $120,000 less than the competition? That's a huge difference. I was reading about their branding, and this is where it gets kind of fast food in a good way, or maybe a scary way, depending on your perspective.
It is a bit like that. They have this dual brand strategy, and this is absolutely key to understanding their efficiency. They basically have two engines driving the car.
Okay.
And engine one is the main brand, Century Communities. This accounts for about, say, 65% of their volume. It has a more traditional feel, you have model homes, you have sales centers, and you have a little bit of personalization.
Define a little bit. What are we talking about here?
Think of it like a nicer, fast casual restaurant. You know, you can choose your side dish, maybe you can swap the sauce, but the core menu is set. You can't ask the chef to invent a new dish for you.
Okay, so that's the premium burger. But then you have engine two, Century Complete.
This is the hardcore efficiency model. This accounts for about 35% of their volume right now, and it is growing fast.
Right.
In the Century Complete model, there are 0 upgrades, 0 options.
I have to stop you there because when I read 0 options in the report, I thought I misunderstood. You mean I can't choose the cabinet color. I can't pick a different carpet.
You cannot choose the cabinet color.
Yeah.
You cannot ask them to move a wall 6 inches. You cannot upgrade the carpet. You cannot add a ceiling fan if it is not in the original plans.
Seriously?
They build the house according to a predetermined, highly optimized specification, and you buy it as is, period.
That sounds, I don't know, austere. In 2026, we are so used to customizing everything. I can customize the color of the Nike swoosh on my sneakers online. Doesn't that turn buyers off?
You would think so. But you have to look at the alternative. If the choice is ugly cabinets and a mortgage I can afford versus beautiful custom cabinets and staying a renter forever,
The ugly cabinets win.
the ugly cabinets win every single time. They're selling home ownership. They are not selling interior design.
That is a brutal trade-off, but I guess that's the reality of the market we're in. And with Century Complete, they don't even have model homes, do they?
Correct. They sell via retail studios, sometimes in strip malls. I mean, literally next to a dry cleaner or a Subway and this is happening more and more, entirely online.
So it's pure overhead reduction.
It completely removes the cost of building, staffing, and maintaining a beautifully staged model home in every single neighborhood.
It's treating the house like a true commodity. Like you're buying an iPhone, you pick the size, maybe the color if you're lucky, and you click checkout.
And that leads us directly to the most important operational term for this entire deep dive, the spec revolution.
Spec as in speculative, billing it before you even have a buyer lined up.
Correct. In the olden days, or for most custom builders today, the process is find a buyer, sign a contract, get a hefty deposit, and then you break ground. That's built to order.
It's safe. It's safe for the builder because the house is already sold before you even pour the concrete.
Very safe. But Century Communities has completely flipped that on its head. In 2025, 99% of their total company deliveries were spec homes.
99%.
And for the Century Complete brand, it was 100%.
So that's basically the entire company. But isn't that incredibly risky? I mean, if you build 1,000 homes on spec and nobody buys them, you are sitting on a massive, massive amount of dead capital. Why take that risk?
You have to view the risk through the lens of the buyer in today's market. In a high interest rate environment, which we are definitely in, certainty is the most valuable commodity there is.
Okay, explain that.
If you're a buyer in 2026 and you sign a contract today for a house that will be ready in 9 months, you are terrified.
Because interest rates could jump from 6.5% to 7.5% in that time.
Exactly. You have no idea what your mortgage payment is going to be in 9 months. You can't lock a rate for that long without paying a fortune for it. So a lot of buyers are just paralyzed. They're stuck on the sideline.
But with a spec home?
With a spec home, the house is already vertical. It's almost done. You can walk through it, you can touch it, and most importantly, you can lock your interest rate today and move in within 30 or 45 days.
So the spec model is really about solving the buyer's anxiety. You're removing the timeline variable from their financial calculation.
You're removing the biggest source of fear. And on the builder's side, it solves their supply chain issues.
Mm.
If you build the exact same house 50 times in a row without waiting for 50 different customers to pick 50 weird tiles from Italy,
Your construction crew moves like a pit crew at a race,
it creates a rhythm, a manufacturing cadence that drives down costs and drives up speed.
which explains their buy online leadership.
Yeah.
I saw on the investor deck they are really pushing this whole digital experience. They want you to be able to tour a home virtually, get pre-approved for a loan, and click buy from your couch.
It reduces their overhead, fewer salespeople, fewer model homes, and it speeds up the transaction. And speed, as we're going to see, is the name of the game here.
Okay, so we have the machine. Cheap houses, built on spec, sold fast with zero customization. Now let's look at what happened in Q4 2025, because this is where the paradox really hits hard.
Yes, this is the juicy part. This is where the finance meets the on-the-ground strategy.
Management made a very controversial call in the fourth quarter. They call it pace over price.
It's a classic volume versus margin trade-off. In late 2025, the market was getting a little sticky. Rates were high. Affordability was really getting crunched. Builders all across the country had inventory just sitting there.
Right.
And Century Communities Management decided, we are not going to sit on these houses. We are going to move them, and we will do whatever it takes.
And whatever it takes meant money. A lot of money.
A lot of money. They offered incentives averaging 1,300 basis points.
Okay, let's unpack that math for anyone listening who isn't a finance nerd. 1,300 basis points is 13%. So if I'm looking at a $400,000 house, a 13% incentive is roughly $52,000.
Correct. 52 grand.
Now, usually when I hear incentive, I think, oh, they just dropped the price by $52,000. But that's not exactly what they did, is it? It's more clever than that.
No. And this is a crucial distinction. If you just drop the sticker price by 52 grand, you really annoy every neighbor who bought the same house last month for the full price. You just tanked their property value.
Bad for business.
Very bad for business. So instead, they keep the list price at $400,000, but they give you that $52,000 in credits to use for things like rate buydowns and closing costs.
We'll get into the mechanics of that rate buy-down in a minute because it is absolutely fascinating. But effectively, the builder is eating that $52,000 cost. That comes straight out of their pocket, out of their profit.
It absolutely devoured their profit margins. Their GAAP gross margins fell to 15.4%.
Oh.
And just for context, during the post-COVID boom, these margins were in the mid to high 20s. Even earlier in 2025, they were higher. 15.4% is razor thin for a home builder. It leaves you very little room for error.
I was looking at their P&L sheet last night, and honestly, I thought there was a typo. You see these margins just bleeding out, but then you look at the bottom line. How on earth did they pull off an earnings beat with such terrible margins?
Volume. Pure, unadulterated volume. They moved 3,030 new homes in just the fourth quarter.
That's a huge number.
It was up 22% sequentially from Q3. They generated $1.2 billion in revenue, beating Wall Street's estimates by $150 million.
So they made less money per house, significantly less, but they sold so many more houses that the pile of cash at the end of the day was still bigger than anyone expected.
Precisely. They delivered an adjusted EPS of $1.59, beating the street's estimate of $1.39. But there's a deeper strategic reason for this beyond just beating the quarterly number. It's about liquidity.
Cash is king.
Always. By selling those homes, even at a lower margin, they converted inventory, which is just piles of wood and concrete sitting on a balance sheet doing nothing, into cold, hard cash. They ended 2025 with $1.1 billion in liquidity.
And that's a fortress, because if the market really turns south in 2026, you want cash, not empty houses. Empty houses cost you money every single day in taxes and insurance. Cash gives you options.
Correct. It also clears out the old inventory so they can start fresh for the 2026 spring selling season. And, crucially, it keeps the machine running.
What do you mean by that?
If you stop building because you have too much unsold inventory, you lose your construction crews, you lose your trade partners, they go work for your competitor. By choosing pace, they kept their construction teams busy and employed, which is absolutely vital for maintaining that speed advantage we talked about.
That's a great point. Speaking of speed, let's transition to Section 3, operational differentiators. Because speed kills competitors in this industry. It's not just a catchy slogan.
It really is the difference between profit and loss. Holding costs will destroy your returns. Every single day a house sits unfinished, you are paying interest on the land loan, you're paying insurance, you're paying property taxes, and you aren't getting paid by the customer.
And the report says CCS hit a record construction cycle time of 114 days.
That is incredibly fast. That is roughly 4 months, from the moment the shovel hits the dirt to the moment they are handing the keys to a new homeowner.
And what's the industry average? Because I feel like I see houses in my neighborhood under construction for, like, a year.
It varies, of course, but generally for a more traditional builder, you were looking at 5, 6, sometimes 7 months. If you're doing a full, custom, built-to-order home, it can easily be 9 months to a year or even more.
So they're building houses 30 to 50% faster than the competition.
And again, that goes directly back to the spec model and the total lack of options. Their supply chain is completely predictable. They know exactly how many windows, how many doors, how many square feet of drywall they need for every single house.
There are no surprises.
0 surprises. No waiting for a special order faucet from Italy that gets stuck in customs for 6 weeks.
It's the Henry Ford assembly line, but applied to housing. But there's another part of their speed and efficiency that I found really interesting, the land light philosophy. This part sounds a bit like financial engineering, but it seems absolutely critical to their survival.
This is critical for understanding their risk profile. You have to remember, in the old days, a lot of builders acted like land speculators.
Right.
They'd go out and buy these massive tracts of land, thousands of acres, and just sit on them for years, developing them slowly. That works great when land prices are going up.
But if land prices drop, you're left holding a very, very heavy bag.
You're stuck with a depreciating asset on your balance sheet. And you have to take what's called an impairment charge. You have to write down the value of that land, which just destroys your earnings for the quarter.
So how does Century avoid that?
They try to avoid it by using option contracts. As of the end of 2025, they control 60,916 lots. But the key word there is control, not own.
Okay.
About 43% of those lots are controlled via options, not owned outright.
Walk us through the option contract. How does that work in practice?
Think of it like putting a deposit down on a venue for a wedding. Let's say the wedding is going to cost you $50,000. You pay a $5,000 deposit today to reserve the venue for next year. You don't pay the full price until the actual event.
Okay, that makes sense.
Now imagine the economy crashes and you decide you just can't afford that big wedding. Or, maybe you just decide not to get married. You walk away. You lose your $5,000 deposit, and that hurts.
Yeah.
But you are not on the hook for the full $50,000.
So in this analogy, the wedding is buying the raw land to build homes on.
Exactly. They pay a relatively small deposit to a land developer to reserve the lots. If the housing market crashes in 2026, they can just walk away from the deal. They lose the deposit, which they just write off as a business expense. But they don't end up owning millions of dollars of dirt that they can't build on or sell.
So it puts a floor on their potential losses. It converts what could be a catastrophic loss into a more manageable, predictable expense.
Precisely. It makes their balance sheet so much more nimble. Because they aren't tying up hundreds of millions of dollars in land banking, they have that $1.1 billion in liquidity we mentioned.
Which they can use for other things.
They can use that cash for other things, like the share buybacks we'll talk about, or dividends, or maybe snapping up distressed opportunities if they arise.
It really seems like they have structured the entire company to survive a downturn. Low fixed costs, fast cycle times, and land options so they're not stuck with depreciating dirt.
Risk defined, portfolio protected. That is the exact phrase management uses on their calls. But there is one more secret weapon they have that we need to talk about. And honestly, this is the only reason they can sell homes when mortgage rates are at 6.5 or 7%.
This is Section 4, vertical integration. And we're talking about their in-house lender, Inspire Home Loans.
Yes. Century Communities isn't just a builder. In many ways, they are also a bank. Or, more accurately, a mortgage lender.
They call it a one-stop shop, but looking at the numbers, it seems like way more than just a convenience for the buyer. The capture rate in 2025 was 84%.
The record high for them.
Wait, 84% of the people who bought a Century house used Century's own lender. That seems incredibly high. Is that just because buyers are lazy and don't want to shop around for a mortgage?
No, not at all. Buyers are actually very price conscious, especially first-time buyers. It's almost all about the math. Remember those 13% incentives we talked about?
The 52 grand on a $400,000 house.
Yeah. They aren't just handing you a briefcase full of cash. They're using that money to buy down your mortgage rate. Yeah. This is where the magic really happens. If you go to a regular bank, say a Bank of America or a Wells Fargo, maybe you get quoted 6.5 or 7% on a 30-year fixed mortgage.
Which is a painful number.
A very painful number. But because Century controls the lending arm, and because they have that $52,000 incentive bucket to play with, they can take that money and effectively prepay some of the interest for you. They buy points to get your rate down to, say, 5.25 or 5.5%.
And for the buyer's monthly payment, that makes a massive, massive difference.
It's huge. On a $350,000 loan, the difference between 7% and 5.25% is hundreds and hundreds of dollars a month. It is literally the difference between qualifying for the loan and getting rejected by the underwriter.
So that's how they are hacking affordability. They are originating loans at 5.25% to 5.5% when the real market rate is significantly higher.
They are essentially subsidizing the interest rate to move the inventory. They are sacrificing their own profit margin on the house to buy the customer a cheaper loan.
And because they own the lender, the transaction is probably way smoother. The lender isn't going to delay the closing because they know the builder's timeline and process.
It's all integrated.
Yeah.
But I noticed something else in the report about the types of loans they were giving out. There was a huge surge in ARM's adjustable rate mortgages.
Ah, yes. The 3-letter acronym that gives everyone who lived through 2008 a little bit of PTSD.
Right. When you hear ARM, you immediately think of the subprime crisis, people getting these teaser rate loans they can't afford that explode a few years later. Why are they bringing these back?
It's a fair question. They have a bad reputation.
But in a high-rate environment, they are, for some people, a rational tool. ARMs accounted for 25% of their originations in Q4.
Wow, 25%.
And that's up from just 5% in Q1. That is a massive shift in consumer behavior in less than a year.
So why the shift? Is it just desperation from buyers?
It's affordability engineering. ARMs offer a lower initial interest rate than a standard 30-year fixed loan. The report specifically mentioned them using teaser rates on these ARMs, sometimes sub 4% for the first few years.
Sub 4%. In this market, that sounds incredibly attractive if you're a buyer.
It is. If you're a buyer, you look at that and you say, okay, I can afford the payment at 3.99%. I'll take the ARM, and I will hope and pray that in 5 or 7 years, when the rate adjusts, interest rates in the general market will have come down, and I can refinance into a new fixed loan.
So it's a bridge loan. They're betting on rates falling in the future.
Correct. It is a calculated risk, no doubt about it, but it's a risk taken by the buyer. For Century, it closes the sale today.
Okay, so we've covered the how. They build fast, they build cheap, and they finance it all themselves with these aggressive rate buy-downs. Now let's look at where are we going? Section 5. The 2026 outlook. Because despite all this crazy margin compression, management is sounding surprisingly confident.
They're absolutely pivoting. The message for 2025 was stabilization, survive the rate hikes, clear the inventory. The message for 2026 is unequivocally growth.
And they put out some pretty bold numbers to back that up.
They did. They're forecasting deliveries of 10,000 to 11,000 homes in 2026, revenue between $3.6 billion and $4.1 billion. But the real headline for me was the longer-term promise.
What was that?
Management claims that their existing lot supply supports 10% annual delivery growth for both 2026 and 2027.
10% growth per year for the next 2 years in this economy, with rates potentially staying high for longer.
That's the claim. And they really emphasize that they can do it without reaching their word. They're not expanding into new, risky territories where they don't know the local regulations or the market dynamics. They're focusing on deepening their market share.
Deepening sounds like corporate speak. What does that actually mean on the ground?
It means they're staying in their existing 16 states. Places like Florida, Texas, the Southeast, some mountain states. Deepening means instead of opening a new division in, say, New York or Chicago, they're going to double down on Jacksonville. They're going to build more communities in San Antonio where they already have a presence.
That makes a lot of sense. You already have the construction crews, the permitting process figured out, the relationships with the local politicians and inspectors in those towns. Just build more there.
Exactly. It leverages their existing local overhead. You don't need to hire a whole new division president and staff. And, crucially, regarding those profit margins, They did mention they plan to start pulling back on incentives.
Ah, the margin recovery. The price part of pace over price is coming back.
That's the plan. Now that they've cleared out the old inventory in Q4, they plan to reduce incentives by about 50 basis points in Q1 2026.
So from 13% down to 12.5%, I mean, that's a baby step.
It is a small step, but it signals direction. They are signaling to the market that the fire sale is over. They think they have enough organic demand and pricing power now to start dialing back the discounts, even if it's just a little bit.
There was also an interesting note about their Century Living segment. This is their multifamily business, their apartment business.
Right, and this is what they call the merchant builder shift. Previously, they might build an apartment complex and then hold on to it for recurring rental income, acting like a landlord.
A long-term hold.
Exactly. Now they're saying, no, we are builders, not landlords. Their expertise is in construction, not property management.
So now they build it, they fill it with tenants to prove that it makes money, and then they sell it immediately.
Immediately, they get it stabilized, get it leased up, and flip it. In Q4, they sold a 300-unit complex for $97.2 million.
That's a nice chunk of change to bring in.
And it recycles capital. Instead of trapping nearly $100 million in one building for 10 years to collect rent checks, they get that cash back immediately, and they can put it right back into
Building more single-family homes. Or buying back their own stock.
or buying back stock. It really emphasizes that their entire corporate DNA is focused on velocity.
Yeah.
Velocity of capital, velocity of construction. They do not want money sitting still.
Velocity is the perfect word for this company. Everything is designed to move fast.
It is.
And there is always a but. I can't let you off the hook without looking at the bear case. Section 6. Because everything we've described sounds pretty good. It's fast, it's efficient, it's growing. But it all seems to rely on a few very fragile things going right.
It absolutely does. This is not a risk-free trade by any means, and the single biggest vulnerability is their core customer.
The entry-level buyer.
This is the most sensitive demographic in the entire economy. The wealthy homebuyer can weather a recession. They have other assets. But the entry-level buyer, the teacher, the shift worker, they often cannot. If unemployment ticks up even a little bit, these buyers vanish.
They don't have big savings buffers.
No, and they don't have equity from a previous home to roll over into the new one.
And if interest rates spike again, Century has to spend even more on those incentives to buy the rate down for them.
Which crushes their margins even further. We saw margins hit 15.4%. How much lower can they actually go before the entire business model breaks? If the market rate hits 8%, the cost to buy that down to 5.5 becomes astronomical. The math just stops working.
So they are incredibly sensitive to interest rates. They're basically fighting financial gravity every single day.
They are. And then there's the issue of scale. We call them a machine. But when you compare them to the industry giants, they're actually kind of small.
They have about 1.6% market share, according to the documents.
Right. Now, compare that to a company like D.R. Horton, which has around 25% market share, or Lennar at 15%. D.R. Horton is the Godzilla of American home building.
Why does that matter so much? I mean, if Century is profitable on its own, who cares if Horton is bigger?
Purchasing power. When D.R. Horton calls a lumber supplier, they don't ask for the price, they dictate the price. They say, we are buying lumber for 50,000 homes this year, give us your absolute best rate.
And Century has to negotiate.
Century negotiates. In a supply chain war, say, if lumber or concrete becomes scarce again, the giants win. They get the materials first, and they get them cheaper.
So CCS has to be smarter and faster because they can't just bully their way through the supply chain.
Exactly. And then there's the final piece, which is geographic risk. They are very heavy in the Southeast, very heavy in Florida, places like Jacksonville and North Florida.
And you can't talk about Florida real estate without talking about insurance.
Insurance is becoming an absolute nightmare in Florida. Premiums are skyrocketing because of climate risks, hurricanes, flooding. And you have to remember, the entry-level buyer is exquisitely sensitive to the total monthly payment.
Right.
If their home insurance bill goes up by $200 a month, that creates the exact same affordability problem as a 1% interest rate hike.
That's a very real risk. If you can't get insurance on the home cheaply, you can't get the mortgage. It doesn't matter how cheap the house itself is.
Exactly. So the weather events and the insurance markets in the Southeast are a huge structural headwind for any builder that's heavily concentrated there.
Okay, so we have the bull case. Speed, value, growth, the Amazonification of housing, and we have the bear case, interest rate sensitivity, a scale disadvantage, and these insurance risks. Let's get to the verdict. Section 7. Is Century Communities a deep value buy, or is it a value trap?
Well, let's start with the valuation itself, because it's pretty stark. The stock is trading at a significant discount to its book value.
Okay, I want to use an analogy here for the listeners. Explain book value like I'm 5.
Okay. Imagine you buy a wallet. Inside that wallet is $100 in cash. The book value of that wallet is $100.
Simple enough.
Right now, the stock market is selling you shares of Century Communities for roughly $75.
So I'm buying a wallet that has $100 in it, but I only have to pay $75 for it.
Effectively, yes. You are buying the company's assets, the cash, the land they own, the houses under construction, all of it, for 75 cents on the dollar. The stock is trading at about 0.75 times book value.
That sounds like a no-brainer. Why would the market do that? Is the market just stupid?
The market isn't stupid. The market is fearful. The market is basically saying, we think that $100 inside the wallet might be counterfeit. Or, more accurately, we think the land you own is going to drop in value, so it won't really be worth $100 next year. That's the whole value trap fear.
But management clearly disagrees with the market's assessment.
They disagree vehemently. And they're proving it with their actions. That's why they repurchased 7% of their total outstanding shares in 2025 alone. That is a very, very aggressive buyback program.
So that's them putting their money where their mouth is. They're screaming from the rooftops, our stock is on sale, so we are going to buy as much of it as we can ourselves.
And on top of that, they pay a dividend, which is currently yielding around 1.8%. They're returning capital to shareholders in multiple ways, very aggressively.
So what's your final take? You have to choose one. Deep value or value trap?
I'm leaning toward deep value, but with one major caveat.
Yeah.
I think the landlight model puts a real floor under the risk. They aren't going to go bust because of a land crash.
Yeah.
Because they can just walk away from those option contracts.
Right.
If rates just stabilize, I mean, even if they don't drop, if they just stop going up, that 10% growth potential combined with the huge discount to book value creates a very compelling case for a lot of upside.
But the caveat is?
The caveat is margins. They cannot survive forever on 15% gross margins. They have to prove in 2026 that they can successfully pull back on those incentives and stop buying sales. The entire bull thesis relies on that pivot. If margins stay compressed at these levels, the earnings growth just evaporates.
So watch the margins in Q1 and Q2 of 2026. If they creep back up to, say, 18 or 19%, the thesis holds. If they're still stuck down at 15, we have a problem.
Precisely. That is the single most important metric to watch for this company over the next 6 months.
This has been a fascinating look at how the sausage gets made, or rather how the affordable house gets made in America today. It's not pretty, it's not romantic, but man, it is efficient.
It is a volume game. It's the complete industrialization of the American dream.
To wrap this all up, I want to leave you, the listener, with a final thought. We talked a lot about the spec model. 99% of homes built without a buyer. Standard finishes, often bought online. Is this the future of all housing? As homes become more and more unaffordable, are we seeing the death of the custom dream home? Will houses just become standardized commodities like iPhones where we sacrifice all personal choice just to keep that monthly payment reachable?
It's a provocative question. In a world where efficiency might be the only weapon we have to combat inflation and affordability issues, standardization might be the only path to homeownership for the next generation. We might look back on the idea of custom homes the same way we now look at, say, tailored suits, as a beautiful luxury that only the very rich can afford.
A sobering but very interesting thought. That is it for this deep dive on Century Communities. Thanks for listening, and we'll catch you on the next one.
Thanks, everyone.